Welcome back, everyone. Happy 2026. Hope you guys had a good new year and a great Christmas break. It's been a while since I posted, but today I wanted to go through my portfolio performance in 2025. Most of you probably don't know this, but in 2025 is the year that I actually started to invest seriously. If you look at my all-time portfolio, I did have an account back in 2023 and 2024, which I ended up just emptying. In 2025 and late 2024 is when I really started to get serious. I deposited a lot of my savings, and it's where I started building and compounding my wealth. Well, it's 2026 now, and we can finally review kind of my performance in 2025. And lucky for us, we have softwares that can do it for us. In this video, I kind of want to go through my portfolio, my performance compared to the S&P and the NASDAQ 100. I'm going to go through all my investments, kind of have a little sentiment update on all my holdings and kind of my best performers, my worst performers, my biggest mistakes, and etc., etc. Let's just get right into it. So this is my current portfolio, my brokerage account. We're at $70,289. The market has kind of rallied quite a bit in the first week, so I have the numbers of just 2025 January 1st to December 31st. But before I do that, I just want to break down, these are my registered accounts, so these are all tax advantage accounts. The TFSA is equivalent to the Roth IRA, and then the RSP and FHSA are the Canadian equivalents to like traditional IRA. So it's just a retirement account. Another thing to note is that my FHSA, one of these accounts, I just hold a bunch of indexes, so it's not really anything too fancy. It's a bunch of Canadian indexes, gold, Bitcoin index, and it's very small. The majority of holding in this is just a cash ETF. So I have $6,000 in a cash ETF in my future fund. I also have $1,100 of cash to invest. So really, what I have about only $900 invested in my FHSA. So my brokerage account is nice enough to include all my performance data. So what I did was I took these numbers, the December 31st account value and net deposits, and I took the January 1st, 2025, and this number and calculated the amount of gains that I had. Overall, I think I did pretty well for my first year of investing. So overall, if you include my FHSA, again, my FHSA only holds about $1,000 in indexes. So I'm just going to include that just for the sake of transparency. And in total, I had a total return about 18.9%, whereas in the S&P returned 17.86% and the QQQ returned 20.77%. So I beat the S&P about 1% with all my money, and I lagged behind the QQQ. So just a performance in between the S&P and the QQQ. But again, my FHSA is a bunch of indexes with $7,000 of cash. So how did my stock picks do in 2025? Well, here it is. Here's my performance in 2025. And also, I just want to note that I opened the RSP 3 months in September of 2025. So it was only 3 months of performance, which is why the return is pretty minimal. But based on just the RSP, all my stock picks, and I did invest in stocks in there, I returned 22%. That to me is kind of crazy because when I first started investing in the beginning of 2025, I knew nothing pretty much. I didn't even know how to value business. I didn't know what a DCF is. I didn't know what an income statement is. I didn't know what a balance sheet was. I knew of them. I knew the names, but I didn't know how to read them. I didn't know what cash flow statement was. Anything really. I didn't know any of it. And through 2025, I've been learning and consistently learning, and I'm by no means an expert, but it's really insane to see kind of the growth and kind of the returns that you could get in the stock market. And I think I've done pretty well for myself, especially as the first year of investing. Obviously, it's pretty easy when the market is up. Obviously, it helps that the S&P and the QQQ are are continuing to just skyrocket. So it definitely helps that. But in general, I'm quite happy with my performance, and a win is a win, you know. I know some of you watching this video, it's like, what the heck, dude? You only beat the S&P and the QQQ by like 4%, 1%, you know? Like, come on, like why would you not just invest in the index itself? Here's the thing. I have this compound interest calculator. So I put in $100,000 initial investment. We have a length of return about 25 years, and the estimated interest rate, or your return rate, is about 12%, and I put a 2% variance compounded annually, just based on the 2% over 25 years. The difference between an 8% return, a 10% return, and a 12% return every year is a whopping almost $1 million. So you might think 2% is such a little number, a small number, but if you can consistently outbeat the S&P by 1, 2, 3%, it adds up quite a bit in the long run. Another thing to note is the difference between 10% and 12%, $600,000, which is kind of crazy. Anyways, that's something to keep in mind, you know. Okay, so that's my performance. So let's just go through my two portfolios. So again, I have two portfolios that I have stock picks. Here are all my stock positions and the total gains, or the total value of all my positions. So I have about only 15 holdings. And two of them, one of them is a Canadian hedged version, the other one, and which is Nike. So that's why Nike split into two. But so I only have 14 holdings, two of which are pretty insignificant, at about 0.17 and 0.27% of the total portfolio. These are just watcher positions, and I'm just watching a stock. I think it's interesting, and so I just bought a share. It's easier to track, I find, a stock when you kind of own a bit of it, even if it's like a couple dollars. I think I have like maybe $200 worth of each stock, or less than. I think I only have like around $100 worth USD of each stock. And so let's go through my sentiment, the sentiment of all my holdings. So starting off with Google, I think Google right now is a little overvalued. I'm not gonna lie. It's trading at a 1.84 free cash flow yield. Although on a PE basis, it doesn't seem that expensive. But for a company that's growing about like 10 to 12% top line, I think it might be a little expensive. I think it's around fair value to a little bit overvalued. I wouldn't buy it at this price. It's definitely ran up. It's definitely had its moments in 2025, and it's been my biggest winner of my portfolio, with about 78% in total gains. So again, Google, a little expensive, not really a buy here. Maybe you can look to start a position in a dip if you really like Google, the company. I'm going to continue to hold it because I think their story is still playing out. They have their robo-taxis, they have YouTube, they have their Google Cloud and Google Gemini. And I think overall it's a great story, and I want to continue to follow it. I did consider maybe trimming the position a little bit if it does run up, but that's only if I have other stocks other investments that maybe I see that are undervalued. So Google is definitely gonna stay in the portfolio. Next up is Amazon. Amazon is about 17% return. I think in the new year, around December 31st, it was only about 10%. So it's ran up in the past 12 days, which is kind of crazy. Amazon, I think, is undervalued. Its stock performance, and I might do a video about this later, maybe next week or another following week. But in the past year, it's only about up 13%, which has lagged the S&P and the QQQ quite a bit. Year to date, it's up 9%. Holy shit, never mind. But yeah, it's definitely underperformed. It's lagging behind the S&P and the QQQ. So I think the story here is that they have AI and they have robotics, and I think they can really improve their operating efficiency and their margins a lot with the AI and robotics technology. Another thing that I think people are discounting is that Amazon has a chance of increasing their Prime subscription cost. I think they raise it every 4 years, and 2026 is maybe the year that they might increase it, and they haven't really priced that in terms of the growth. ASML. ASML also has been quite the big winner in the past 12 days. It's up 9% as well. But ASML also has been quite a big winner for me. It's up 70% from where I bought it. And ASML is just, it was undervalued, but now I would say it's around fair value. Maybe heard of ASML, but ASML makes lithography machines. They're the machine that makes the semiconductor chips that is needed for AI in these infrastructures. And the next stock is AMD. AMD was quite a good performer in the beginning of the year, but it's died down recently. In the second half of 2026, but I think the story is also still playing out. Yeah, I don't have much to say about it. I think AMD is not a buy at this price, but it still has potential upside, potential growth. I would say this is a hold. MasterCard, and there has been recent news about MasterCard. I think it's around fair valued right now. Fair value to undervalued. If you do want to start a position in MasterCard, I wouldn't say it's the best time to start, especially at these valuations, but it's definitely not a bad play. But yeah, MasterCard is one of my larger holdings. It's only up about 6% and it makes up 10% of my portfolio. Yeah, that's MasterCard. My next stock is Hess Midstream. Hess Midstream is a midstream company, and what it essentially does is it's an oil and gas play, and they own the infrastructure that is required to extract the oil. So they don't actually sell the oil, they just rent their equipment out. So they do processing like transporting, drilling, and refining processes. So they own all the equipment in those processes, but they don't actually sell the oil. So they're a little shielded from the oil prices because these companies that actually sell the oil will have to rent and pay a fee to Hess Midstream, and they make their money regardless of the price. It's a fixed contract, right? So when you rent your house, just because the housing market is up or down may impact your rental just a little bit, but in long term it's quite small, and it's kind of shielded from the main price volatility from oil. Recently it's traded down, and I think it's definitely a buy at these prices. $42 a share to almost $32-ish a share. Is now at a $34 per share. I might do a video about this company as well. But Hess Midstream is definitely one of the stocks that I've been buying in the back half of 2025. It's about 7.89% of my total portfolio, and I'm gonna continue to dollar cost average this one, I think. My next stock in my portfolio is Adobe. I was early to Adobe. I started buying Adobe like in the first half of 2026, even before the tariff drops. And so I've been dollar cost averaging down. Adobe is down 10% for me. I think it's undervalued, man. I've made a video about Adobe. If you haven't watched it, you should go check it out. But yeah, this Adobe is undervalued. I'm definitely gonna buy more if it continues to dip. I have a feeling it might go down further, and I'm gonna pick up shares. Like, I'm definitely picking up shares. My next stock is Nike, and Nike is actually a almost 6% position for me, 5.7 if you add up my Canadian hedged version. In general, Nike I think is also I can't say it's undervalued, but I can say that the stock may rebound. Just looking at multiples, it looks really expensive. Again, I have a video on this, but that's primarily because its operating margins have plummeted. If it could go back to its historical operating margins, it's trading about a 20 PE, which is quite cheap for Nike historically. But yeah, Nike's currently in a turnaround. There's kind of really two sides to Nike. There's no really people in the middle. Some people really believe in the brand, some people really don't. There's a lot of Nike haters, but I believe in the brand. I believe that Nike can make a comeback, and I have my money in it. 6% position, 5.7. I'm going to continue look to add more if it continues to dip down. But yeah, I think Nike is definitely a buy, regardless of what people say. I'm just going to continue dollar cost average. Please watch my video, man. If you're looking into Nike, I have a video about it. Check it out. Another stock that my next stock is Equifax. Equifax is about 9% down. I'm down 9% on it. It's about a 5% position. I haven't really touched Equifax. I bought it a while during the tariff dip, and it hasn't really moved anywhere from then. Yeah, look, tariff dip dropped about 205. I bought it like here-ish. I don't know, here, this initial tariff dip. Still down. I don't know what really, there's not much to say about Equifax. Equifax is a great company. They started buying back shares last quarter. The main story behind Equifax is that they have their work number, which gives kind of like an employee background, and that data is quite valuable, and that's kind of a bullish part of the story on Equifax. Also, the housing market has just been like slower, and the lowering interest rates could be a tailwind for this company. I don't know, there's definitely other opportunities, but I want to see how the story plays out, you know. I'm gonna move on. Uber is not as significant as a position that I wanted to be. It's traded down quite a bit, and I'm gonna look into adding more. But Uber is trading quite cheap. It's gone down quite a bit. People think robotaxi is really gonna disrupt the business. In my opinion, there is that risk. You can't discount the risk, but you gotta think about Uber as not a ride-hailing business, but a ride-hailing management business. They're kind of a tech company first. They're really good at managing fleets of vehicles, and they provide a software that can streamline that. People always think it's just like a taxi business. It is, and it's not. That's kind of the bull case for Uber, where these robotaxi businesses, let's say Waymo, if they are going to be successful, going to have thousands and thousands of vehicles running all at once. And how do you manage that? Well, you can use Uber's platform, and they already have regulations, and they have kind of developed their software to do this for many years now. And so I'm bullish on Uber. The next stock I have is Salesforce. I'll be honest, I bought Salesforce just because it dipped. There was one day where there was a huge dip in Salesforce, and I thought, wow, it's just trading so cheap that I might just buy some. It's not one of my highest conviction bets. I may sell it eventually. It's not terrible. The only thing about Salesforce is that their revenue growth is slowing down, which is not great. Okay, my next stock is Copart, and Copart is one of the stocks that I'm looking to add more in 2025. It's trading quite low. Look, in 2025, the stock kind of really took a hit because of their numbers. They projected a lot slower growth, and which caused a huge sell-off. Their free cash flow is gonna continue to grow. I might make a video on this stock as well. Probably a stock video on Amazon, a stock video on Copart. But look at the valuation, man. Like historically, this stock does not trade at this type of valuation. Free cash flow yield of almost all-time high. Price to sales is like almost at 2022 lows, and price to earnings is at a 24, like a 5-year low. Again, the growth is like they're projected to slow down in growth, but they're able to maintain their profitability because these used cars are so expensive. Another thing is that they have a lot of land that they own. Another thing is that compared to their counterparts, like I think it's called ANA or AIA, Copart owns the land that they put their cars on, and that land has appreciated in value and is worth quite a bit. And so their margins are quite high. The only thing is that the only negative cases right now against Copart is that one, insurance claims are lowering. People, because of the increases in the insurance premium, some people have stopped even using insurance and just driving without insurance. So that would decrease the amount of cars that Copart has. And also they just went through a quarter where it's just really tough comps, because last year there was a huge natural disaster which caused a lot of cars to go to Copart, and they were able to sell those cars. So overall, they continued to maintain their earnings because of their car sales, but revenue is projected to slow down. I believe that in the future, Copart is going to continue to do well. And that's pretty much all my holdings. That's 99% of my holdings, actually. 99.5%. The last two stocks that I have, and which is like nothing, is Cheesecake Factory and Zeta Group. And Cheesecake Factory has ran up since I bought it. It's up 23%, which is... And then the other stock that I recently started a watcher position is called Zeta. Zeta is a small cap company. I think it's quite a small company. It's recently flipped. It's flipping to profitability. Yeah, that's the sentiment update on all my stocks. And yeah, let me know in the comments what you think about my portfolio, But anyways, I think this 2026 is going to be a good year. I'm going to continue to be invested, continue to post. Stay tuned, subscribe if you haven't, and I'll see you guys in the next video. Cheers, guys.